I mean, if you want to push it for later, I don't mind as well. If more people
It's
want.
okay. It's okay. As long as people can see the recording, I'm happy.
All right, cool.
Just let me know. Just let me know when you see my screen, okay?
Sure. I'm seeing your screen now.
Okay, too good. Too good. Alright, let's get started. Alright, so this is a second lit group call. A lot of you guys will be seeing this recorded, which is cool. I got it recorded in high quality, so thanks for that heads up as well. It's a much better heads up because I did look back at some of the other videos, and yeah, you need full HD these days for sure. But yeah, if you want, you can ask me questions along the way, and you could probably be a voice for some other people probably wanting to ask questions along the way as well. But yeah, we'll get into it. So just the first thing with inducement, a lot of people ask, what really is inducement? What's inducement trap trading? Um, and that's fair enough because a lot of people throw around the word thinking they can trade with it. But it's a little bit different to liquidity. They have the same function, but inducement is purposeful liquidity. So I'll just read this out real quick. Let me hide this. So inducement's a building of manipulative liquidity before an area of buying or selling. So this acts as fuel for the real move to be made. So essentially, when we're taking out inducement, we're taking out orders to be able to fuel the real move. It's our job to spot it before it happens, so many people lose in trading because they're the ones getting induced. So that is the fuel for the institutions, the people getting induced. Now, the job of the institutions is to trap as many people as they can before they real move, and they benefit from it because the more people they actually trap, the bigger the movement's going to be. So in a way, you can formulate this whole idea, and it's the more so the inducement amount taken equals the distance of movement from the OB mitigation times momentum. So breaking that down, the more inducement that we take, the more distance the move's going to make when it taps into our order block, and that coincides with momentum. If we have a heavy momentum, we don't need to take out as much inducement. If we only have a little bit of momentum or a sideways momentum, then we're going to have to take out a little bit more inducement. So that's really where the high time frame comes into play. Um, but let's just read these examples. If momentum is very bearish, less inducements needing to be swept to make a medium to large sell move. So if we're very bearish, we'll get into example next slide for these. And if momentum is very bullish, a lot of inducement is needing to be swept to make a medium to large sell move. Okay. Now, because we're human, we'll never know exactly how much inducement is needed to be able to make perfect distance entries. We're not an algorithm. We're not the computer that actually understands that gets that exact numerical feedback. We'll never know. So it's our job to identify based on our momentum, based on how much inducement we're taking to be able to take that trade. So that's why it's important to partial or put your stop loss at break even, however, you personally want to do it. And accept losses and evaluate losses. So a valid loss is something I don't like to hear, which I've said before, because when you have a valid loss, you actually, in a way, you made a mistake. If you're accepting losses, but you're still profitable, that's okay. But you're limiting your potential of what you can learn for yourself. So how can we take advantage of this formula? So if we can evaluate the momentum of price, we can attain an understanding of how much we need to manipulate it. Like I said, momentum and inducement go hand in hand. We don't need to take out as much inducement if we have a heavy bearish momentum and we're looking for a sell, for example. Same thing with buyers and bearish momentum. We always need to see a form of manipulation before we take a trade, whether it's a reversal or a continuation. And that's exactly what the two-phase theorem comes from. We're always looking for an inducement before we take our trade. We use horizontal levels for our inducement, and it's powerful because it's that cutoff between accumulation and manipulation, and then we can trade from that cutoff manipulation. Okay. Momentum helps us to identify a high time frame influence. Everything is a product of what happens to the left. So if we're on a 5 minute and we're zoomed into a chart and we're fully zoomed in and we're just trying to trade from what's happening on the 5 minute, we're not going to know what price is exactly wanting to do because we're not looking to the left on the higher time frame. That higher time frame gives everything to what the lower time frame does, and we know everything is fractal, so everything happens on the same time frame. So higher time frame is so important, and it acknowledges the predetermination of the market to help us identify which levels price is trying to target. So before a big move happens, the market maker already knows what they're going to do, and that's really what that predetermination is. So if we can acknowledge and actually analyze and see that predetermination, it can help us actually understand what that trade's going to do and how it's going to be taken. Okay. So this is just this first one here. Okay. So if momentum is very bearish, less inducement is needing to be swept to make a medium or large sell move. Okay. So this is a 2-hour graph, I think. And as we can see, we had that large impulsive move. Can I ask you, can you see my mouse? Can you see it?
Yeah.
You can, okay, cool. So we had this large body impulsive move to the downside. So we're clearly heavily bearish. In this case, we have this kind of sideways movement here after an adjustment of reacting to a break of structure to the downside, which we know is the same as inducement pullback. We pull back from there, create some equal lows, and we take out inducement, but we have a huge move after only taking out a small kind of range of inducement. And that just shows how much momentum has an influence on the size of moves, okay? So in this case, the heavily bearish momentum, we're riding the wave, we're trading with that, we're finding that point of failure that calls that break, waiting for that to get induced. Once it does, we're good to go. But see how price doesn't have to come all the way back here when we have a break of structure? Because of that momentum, okay? So when we see a large momentum, mainly from the higher time frame, we can zoom in onto what's happening on a lower time frame and kind of trade with a bit more lenience rather than a sideways momentum where we're going to have to take out more inducement to make an up or down move. Okay. So next example here is if momentum is very bullish, so this is on the higher time frame and talking in bullish from this bottom to this top, okay, we have a very bullish movement. A lot of inducements needed to be swept to make a large sell move. So when we get to our order block, when we get to our point, we have that large sell-off. To be able to have this large sell-off and switch this momentum, bullish momentum, to bearish momentum, we have to take out more inducement. So see here, we're following that wave with a smaller amount of inducement, and these are on the same time frame, okay? But when we look at this, we have a long range of inducement, meaning all these people under this horizontal inducement level all got taken out. They all got liquidated by this specific move here. We know that by the fact that this mitigated to here. Okay, so we're finding that at the end of that mitigation cycle, that's how we find our inducement. But if we break it down to retail perspective, we had kind of that down trend line, that breakout. A lot of people are going to buy this breakout, then they get liquidated as well. This is on the 2-hour especially, which means it's billions to trillions of dollars. I don't know exactly, but the more we induce, the more we're able to change our direction quick enough. So it's all about that inducement at the end of the day. This is another example of just the same scenario, right? We have a kind of a sideways momentum, but from this low we have a lot of bullish momentum kicking in the market. So what do? We take out every single one of these sellers who haven't already taken profit already by taking out the mitigation cycle. So all these people have a sad face now because they all got their stop losses taken out by the end of that horizontal level, take out all these people underneath, and then it reverses. So it's a big example of how they take out a lot of inducement to fuel a big move like that. Okay, and it's our job to spot these inducements to be able to trade with the manipulation. Let's have a drink real quick. Okay, so this is a bit more of a deep dive into it. This is on the 5 minute, and we're going to break this down fully, okay? Now, the idea is that we're switching momentum here. This is not this example, but this is how we kind of switch that momentum and take that inducement, okay? And how the high time frame interacts with this. So starting from left to right, the high time frame momentum is sideways. Super important to note. If I zoom down right now, we'd see price action be pretty sideways, pretty horizontal, okay? So on the 15 though, if we zoom out to the 15 or even the 1 hour, our momentum is quite bullish, okay? We're coming from a low that had a lot of buying pressure, okay? And we're meeting into this order block to the left, right? This level here is the inducement level for that order block. Now let's see what happens here. So as soon as we react to our order block, we tap into our vector level, knowing that is the one that swept our inducement level, okay? After tapping into our vector level, we create our phase 2 inducement. So part 1, we enter the OB with the bullish momentum. Now what happens next? Part 2, price creates a new order block, right? With phase 2 inducement. So after we react to that vector level, we create kind of that trend line inducement here, but we got that top level, the end of that mitigation cycle, and that's our phase 2 inducement there. This hints that we are looking to shift momentum to the downside. So, objectively what's happening is we're mitigating demand in this leg so we can target something lower. So this is our last point of demand until this point of demand. So prices can essentially run to this point after we've been able to take out and induce those buyers, okay? Looking at this looks like a trend breakout as well, so that adds to that inducement for this point. Now this phase 2 creates a highlighted drop, so this drop here, and that's what that phase 2 does for us. That inducement here is able to set price from this distance to this distance here to be able to mitigate that last point of demand. Now, we're in a demand, so we're going to react again, okay? So let's look at part 3, what happens in between this and this line. Part 3, price sweeps inducement again to fuel the move to that next pullback demand. So we're seeing a constant pattern of new order block creation, inducement, next demand. New order block creation, inducement, next demand. So what really highlights this for us is the importance of this leg. Where do we have active demand in this leg where we're going to react to? Okay. So now, we've respected these inducements, gone down, respected this inducement, which is a very nice sell in Frankfurt here, the blue being Asia. And then from that sweep, from this point, we run down to that last point of demand in our 15-minute leg. So now we can see that from part 2, that second phase, we've created a new 15-minute momentum to the downside. So realistically, we've shifted this bullish momentum and shifted it into a bearish momentum by reacting and mitigating these original orders from the left, showing the importance of the left, okay? Now, part 4, the main 1 hour leg, so I'm saying 1 hour leg is this leg here to this leg here, is all mitigated now. We've reacted to that last point of demand in that leg, so there's no more demand left for us to react to. So that next target, if we break, push up that demand and we break, is this low here. So it's all mitigated, and here we've built a final form of inducement to run the low. Here we have a long chain of inducement. We have an area here which we respected, we respected some price action here, but we have a clear inducement for where those orders actually are. And we know we had that break in the market here. So this money was transferred to here, which is transferred to here, which is transferred down this leg here, and now it's ended up transferring to here after we swept that inducement, filled that imbalance in. We have a new momentum and we're trading with, and we've taken a large amount of inducement orders, hence this impulsive drop. That impulsive drop is telling us we've taken out so much inducement to the downside, and we have such a clear target now to trade to, because all that demand's been taken out, that we just absolutely bombed to that level there. And that's where that volatility comes in. Those random times of volatility are really important to analyze because of being interacting and taking out those certain points of inducement. So just here, just mentioning here, all mitigated price action to take. If you have buyers at this point, right? Obviously, there's some inducement here that got respected for this pullback, but buyers here are instantly trapped, and we got to recognize this as well on a buy side kind of idea. So first off, here is before Asia, so we're not in manipulation time, but this low here gets respected here, and then that little wick grabs those orders, that grabs those orders, we're moving up, 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 up. That last point of demand from the very bottom of our leg is all the way up here. As soon as it breaks, we run to that bottom because there's no more demand left for us to, react from or move. Okay, and that strong inducement sweep just fuels that big impulsive move as well. Okay, even in Asia it did that. So most often it's London or New York. Um, but yeah, in this case it was Asia. Okay. Do you have any questions about that, bro?
Yeah. So some of the questions I had, you've kind of answered it as you've gone through.
Yep.
But with that last part there, in terms of if you're looking at it from a buyer side perspective, at what point do you, because obviously in hindsight now we can see, okay, it was a continuation for the sellers.
Yep.
But we're looking at it from a buyer's perspective, it could, so where you have your little notation, all mitigations PA today,
Yep.
like that side,
Yep.
that just above that would look like inducement to me for buyers. So it would look like a probably like a reversal back because uh, that's a higher time frame demand, pullback demand, isn't it?
So do you mean this inducement that we sweep here?
No, to the one in the grey box.
The one in the grey box.
So
Let me
all of
look at
that.
that. As
If you're looking at,
inducement for this demand here.
yeah,
Yeah, it is inducement for that demand, exactly. It actually is. So we have demand here, right? We have some imbalance, and then this reacts to this, to this. So that is inducement for this. But realistically, we can trade from that 100%. It is out of time, but that's 100% a great trade. First thing, though, that I'm seeing is that we're in low volatility. Okay, so low volatility, we can't expect any big moves because we're not in session. The next thing though is that just because inducement's taken out here doesn't mean price is going to go all the way up here. This inducement is fueling this move to reach this level. So there's some exactness that we can't fully always analyze, but if we understand that this inducement is for this move to here, that fueled that move. So there's some like connection within the market. Um, but yeah, that you're right.
uh,
It is inducement for this
I
move.
understand from that perspective what you're saying.
Yep.
To it fuels for the continuation inducement, but uh, what signs are you looking for? As so, if I'm in a buy position and I'm thinking it's gonna go to the upside more and take out all the buy side liquidity, which uh, the momentum just came from,
Yep.
what would I be looking for to say, okay, no, I'm in the trade wrong and it's actually gonna reverse on me?
In the scenario that you had a buy trade here,
Yes.
Yeah, so first thing I'm looking at, if I'm in a buy trade, that's a good buy trade. Just to say now, it's a good buy trade because you've identified that inducement. It's a nice inducement entry. But what am I going to look at? I'm going to look at where price can react from if I'm in this trade. Now, here, right, we've followed this money from this point down to this point here, and then we've detached with that imbalance. What's that telling me? It means that break here, which is, a part of this break here, all this above that imbalance is holding these original sell orders. We have not mitigated these sell orders yet. So at this point, buy orders, we have more buying, more demand than we do supply right now because we actually haven't mitigated any of these selling orders yet. So the perfect target for a buy trade is this inducement level. Why? Because we know that this came from mitigating this, right? And that's the end point of that mitigation cycle as inducement for this zone here. Um, Trading to this is a smart money trap. We have no inducement for this zone here, so we just end up running that. But if you were in a buy trade here, you have to have a non-biased understanding that we haven't tapped into sell orders, right? That broke internal structure there. We haven't tapped into any of these orders yet. So we have a sell target, well, a buy target for sells. Um, but now we also have a higher time frame sell target if we're looking for sells. Does that make sense?
Yeah, that makes sense.
Okay.
The issue that I get is I look at where you have pullback demand as thinking, okay, that's the mitigation cycle has kind of finished. It's now it's doing a reversal, and what I tend to get in trouble is like probably hold it from where I said to buy,
Yep.
not understanding until the move's done that it actually was a sell. So I'd be looking to try to target higher, and that's when it kind of comes back and uh, reverses on me.
Yeah, yeah, no, I fully understand what you're saying. Yeah, for sure. So just to answer what you said there, um, that's kind of where internal breaks really come into play. They show us where we had demand. So we had demand here, and then where we failed demand. To be able to fail demand, we need supply. Doesn't matter if we reverse from here or not, we're still reacting to valid supply. Okay? But the fact that we built strong inducement and we built a lot of inducement under this zone tells us that we're ready to rally down. So we might have a bias on buys, but we got to look for that imbalance. So we got to look for those open zones that were produced by these internal breaks. That really is the best way to find order blocks through internal breaks because that is where those points of money are injected. Um, but also a big factor is that we didn't create any more continuational structure. It all became mitigated. Continuational structure, right? This being our vector level, that last point of demand, we didn't create any inducement for it while passing a mitigation cycle. So straight away, this line would be undetermined for me, as I do with all my inducement levels. They're undetermined. Um, and if we are in a buy and we do think it's going to keep going up and we don't notice the extent of what's happening here, where we're building a lot of inducement, we have a lot of sell orders here. If it breaks our vector level, we can hop out the trade here. We're still going to win from here to here. But, we got to essentially mark out all these inducement levels first and have some room for error because we might think it's just an inducement pullback where we continue up. But, if it breaks that rule, we're not going to cross our fingers and stay in the trade. We're just going to jump out. Um, and that's kind of where that systematic approach comes in. But yeah, that's a very good question that you asked. Anything else,
Yeah,
or is it cool to go to the next slide?
no, it's good to go. I think the main point you mentioned was the vector level uh, as a way of managing the trade.
Yeah,
So if I'm
exactly.
and it's either yeah from the vector level it will either continue, or if it breaks that, then I've come out of the trade with still in profit and then can be looking for sales.
Yeah.
Okay, so that's a good managed trade.
Yeah, so a little
And
bit of uncertainty, just follow to see what price is trying to do. Is it trying to create continuation or inducement, or is it looking to reverse with momentum?
and where would you say the vector level is for like the buy before the sales come in?
For
So on the Asian,
Oh, for this pullback demand?
Yeah. So say if I'm managing the trade and I'm in a buy,
Yep.
uh, when from where the it basically impulse is up during Asia, the beginning of Asia, where would you say the vector level is on there?
Yeah, so we have a 15-minute vector level here, okay? I probably should draw on the inducement level here as well, but I didn't want
Mm,
to confuse it too much. But yeah, of course, if you have an inducement level here, you're going to have a vector level that broke that. Now, on the 15-minute, this is where that original injection came into place with that run, right? We have that big body candle there. So at this point, we had that original injection to run that inducement. Now on the 1 minute, we might find like a zone here that took out this level. Um, Now if we break that, it means we're just going to run to our next supply. So we can use kind of our multi-time frame analysis to recognize that yeah, we have a 15-minute vector level, which we're going to sweep inducement for and break, because obviously we can treat this as inducement pullback. This is a vector level, and we're inducing that vector level, so it's a sell continuation. But on the 1 minute, if we break that, well, yeah, that means we can trade to that next point of active supply up here. So that gives credit to buying at this point as well, um, to this point.
I'm talking about, so if I'm buying at that point you just highlighted, and where your mouse is, that up move,
Yep.
if you like from the down, like where would your vector level be from that impulse? Where your mouse is, the impulse
Off for this
down.
inducement level?
Yeah, where would be, so that way, if I'm in a buy sell, I would know where to manage it to, so it would take me out.
Yep. Now this this big line's a little bit in the way, but this is a little wick here, okay? And
Hmm.
that's the vector level. Why is that the vector level? Because all this under here, right? So this is that injection, right? Because we had a low, and then we had that injection sweeping that inducement, right? That's that start of that rally. So it's here, but our vector level can mitigate. What does that mean? It means we can transfer the money from that vector level up the leg. So here mitigated, here. Why am I saying it mitigated? Because we're taking all that money from that point. There's no imbalance. Imbalance is a real trick to see detachment versus mitigation. But all these wicks are grabbing that vector level, and then we had an imbalance here. So we detached from that vector level that started down here, that we moved up to this point. We actually reacted to it here, took some, maybe 1 minute inducement for a really nice little entry there, and then after sweeping those highs, we just rallied down from there. So yeah, that vector level's here, and why did we just run through all this? Because there's all that money from these points have been moved. We can only react to points where there's resting orders for us to have an interest to mitigate. But yeah, all these points have moved all that money up to this singular point already. Once that gets broken, that's why we run it so clean. Does that make sense?
Yeah, no, that makes sense.
Awesome. Okay, we'll go into the next one. So four counterparts of a setup. So just kind of like this, if we're looking for some sell trades here, I'm gonna evaluate technical analysis in a technical analysis view. Four main things before I actually take my setup. So our first one's the order block. Alright. So before inducement is taken for price to raid, then reverse rapidly, we'll be building this short. We'll be building this short of a level of resting orders. So just saying, we're building inducement here for a zone here. So our inducement's going to be quite close to our order block. Why? Because we're not looking, well, the market maker especially is not looking to manipulate all the way up here if the inducement's down here. We're going to be as proximal as possible to that inducement. Um, there are some advanced ways that validate a mitigation of an order block, which we won't go over in this, but we do have different types of order blocks that are listed in the ebook. We do not always need to mitigate that last candle before the impulsive move. A good little tip to sum this up quickly is, as long as, just looking at this for example, as long as we're above the break. Why? Because above that break is where that sell was actually injected. Below that break, we didn't actually break anything. So we're looking above that break. So to under refine, there's no problem as long as your refinement is valid. A great way to understand where we'll mitigate an order block is where the inducement's positioned. Just like I mentioned, price will mitigate something proximal to the sweeping mitigation inducement. So how can we spot good order blocks? How can we spot these zones? Just before I go into the slide that'll show us, never look for zones first. Look for inducement first. Inducement is what we set up before we actually tap and mitigate into our zones. So if we spot the inducement before the zones, we're usually good to go. We can miss a lot of trades if we're just looking for certain zones. Okay, so let's have a look at this. So first things first, this may be 2 days before this, something like that, or 3 or 4. But demand was respected at this point. We had this pull up, and then it failed. So really important that demand gets respected before we break. Here we had demand, and see these wicks reacting, pushing off that demand area, and then us having that break. That's our change of character in the market. That tells us that an injection of orders were made from this point to actually break that. And if it's unmitigated, we're going to end up reacting to it in the future. So that's that first thing we want to look at. The second is, where did that original injection move to? So a good idea is to start from the very top, okay? So very top of where that injection was, and to move down to see where that money actually moved to. In this case, we had that original injection. Lack of imbalance here, price came, swept a little wick, price came up again, grabbed that money, and then here we had imbalance, we had detachment, okay? Just so you know, we don't always need imbalance, as long as an order block is not mitigated, as long as we didn't carry that money down the funnel. So in this case, we have these orders resting here, which is what broke this demand point here. But yeah, imbalance is a great way to see that, okay? So after following that original injection where that money moved to, what do we need to see next? Imbalance or unmitigation. So yeah, we did see here because we detached from that original injection that broke this, okay? So it's super important to be really precise and analytical about your order block. But it doesn't mean over-refine. If you're unsure, just grab that whole thing above there. That's completely fine as well. As long as it's in a place where it's still valid, because at the end of the day, we hop onto the 1 minute and look for a 1 minute entry. So if your 5 minute, 15 minute, 1 hour order block's huge, like some imbalanced ones can be, it doesn't matter, because we're going to go into a lower time frame anyway. So as long as it's valid, really. And now number 4, are we inducing our POI? So yes, we are. If we look at this imbalance, right, this could have been the POI, but because we detached from this, we ended up tapping into this one. But this is where our inducement started. We had this kind of supply level we can look at, like a trap supply. We reacted to that. More orders reacted within that, like a kind of trend line. And then when we broke out of that, we ended up having another small range inducement. How so? Because we broke that, reacted to this, and then added this to our inducement chain. So a little bit of thinking for how that is actually happening. But this piece of supply got added to that inducement chain. We induced, sellers and buyers, took them out, and then from this point we entered manipulation time and then dropped from that level. This horizontal level is what I found from this inducement line here. So if I were to draw that all the way out, being the end of the mitigation cycle, that finds that pure manipulation, and if it's unmitigated, like we have a little wick there, if unmitigated, we come to mitigate that, and that would be like an absolutely perfect trade. Definitely tough to find though, especially when you don't have a clear order block during a low volatility time. But as long as we understand that this money has successfully transferred to this point, we can trade from this point. If it has not successfully mitigated, touched, or entered this point, we're going to look at taking this out and trading something above that, for example. But it's all about how those orders are being transferred from one spot to another with our order blocks.
With sorry,
Yeah, all good.
can you go? Uh, with that last line you were just talking about, why wouldn't that be considered your inducement instead of the line that you put? So the detachment order block that you said could have been an order block.
Oh, this one here.
Yeah,
Yeah,
wouldn't that be the inducement and that compared to the one that you marked out?
down here.
And at what point, yeah, and at what point did you know like the market is shifting to get your entry?
Yeah, okay,
Because
that's a good question. Yeah.
uh, because I can't really, well, from what I'm seeing, the vector level, I would say just where you've put that kind of trend line liquidity.
Yeah, okay.
Uh,
So how I see this, right? If we have that imbalance, right, and then we're mitigating here, yeah, we do have our inducement level there. Um, Realistically, why? Because we're inducing under this level. We can see it as kind of a um, uh, resistance. I get confused. Support resistance. A resistance here, right? Where whenever it bounces off here, people are gonna sell. Okay, and they do that here as well. Now, what happens here? It breaks that inducement, but it does not enter our POI. We always need to see price enter our POI. So in this case, what it did, it mitigated something here, and then added this price action to the inducement chain here. So essentially, I could grab this line and move it up now to here because that mitigated that. But we still haven't tapped into that POI. And we know, based on number two here, where did that original injection of orders move to? It moved to this point here, then we detached. So we're going to be patient until we hit this point exactly. So once we sweep that, yeah, we are adding that and we can move up. But what price does, it creates kind of that, that retail trendline breakout where people here are going to be buying from. That just gives us another way that we can induce and manipulate, you know, buyers in this case, because they're going to have maybe their TP up here, right? But we end up liquidating them by moving down. So this is an example of where we can have our phase two, right? Because we swept phase one and we're in a phase two of inducement before the tap in. Now here we are sweeping inducement as well, and like I said, we don't always know exactly how much inducement we're going to take out, but we can see this is a phase two and this is a phase two. So we can kind of have two phase twos of inducement if we don't take enough out in this phase two. So it does get a little bit complicated, but the main idea is
where
sitting on your hands and
the
waiting till that order block gets tapped. Yeah.
where would be the vector level because of so where your mouse is, if you go down a little bit, I would say that would be the vector level, but where it broke or induced was your entries kind of before that. So I would have waited for something like that to happen, but then the market would have gone away from me and I wouldn't have got an entry like how you see. So how you determine from when it taps into your POI that it's reversing?
Yeah. So here is a vector level because we can move that inducement up the funnel until we reach that order block essentially. So here is my horizontal inducement level, and that takes that one out. We take out the inducement with this demand here. Okay? And what happens is we always have to wait for our vector level, of course. So I don't want to go too much into the vector level because this is a free one, but I will say that this mitigated it here,
Are they,
right? And then we ended up sweeping our last form of inducement. So that's one of the entry rules. I don't want to say too much about how we have the entry set up, but we know that if we tap into this specific level and then create a final form of inducement, we're good to go. Um, but yeah, it would be here because it sweeps that inducement before that POI, that final level of inducement. Does that make sense?
yeah, that makes sense. Probably if I have more questions, we'll leave that for like a private lesson or something like that.
Yeah, 100%. Awesome. Okay. So next one, so this first one was order block. The next one I'm going to look at is inducement, okay? So inducement is trapping people before making the real move. At the end of the day, that's really what it is. But when we're trading, we got to think like the banks because they're the ones controlling the market. We're just the little fish. It's past 80%. We have absolutely no control in what happens, and we have to respect that. Trillions of dollars are putting into the market. Banks print money. They're the ones that put it in. Okay, so what do we got to ask ourselves? What traps are we setting to capture the masses? We might ask some questions like, how can we trap traders? Or they might be asking these questions. We got to think like them. What is our predetermined move? How much do we need to induce to execute the move to our target level? Or how can we trick everyone before that real move? Okay, so let's look at an example here. So we have an order block, kind of an IFC, it sweeps liquidity. We have a move down from that point. But before entering our POI, we obviously have to create our inducement. Now, this is a little bit messy, but that's kind of how you'd be if you're a retail trader, and that's kind of what they're looking for as well. So before we enter that POI, right, where we can grab the body like that, we miss the POI and then start mitigating it, confirming our inducement. Inducement needs to mitigate. We need to build a bunch of people. Here we have a trend line. So we have a high. We're connecting the highs. Connecting, breakout, right? Breakout's a big thing that a lot of people do. They love to buy on the breakout, and some might succeed putting a little trade in. But at the end of the day, we can see it as a manipulation to the breakout. Same thing if you're looking at resistance, right? Could have some support here, but in this case we have a resistance where we can have a wick and we just keep reacting from that wick, and people are going to keep selling every time it either hits that trend line or it hits that that resistance level there. So we got to see that, we got to foresee that and notice that that's a trap that's inducing for this POI here, okay? So just like I said here, they might ask as a retail trader, oh, we got a resistance breakout, so we're going to buy. We have a trend line breakout, so we're going to buy. But they all end up getting liquidated. Their stop losses are probably at this low here, and they get taken out, okay? And the manipulators win, and it's a successful trade because they were able to trap the masses, okay? So just looking at what's happening here with entry, we have that vector level. We respect it. Hop on the 1 minute because this is a 5-minute setup. On that 1 minute, we have our phase 2, okay? That original money got moved to this singular point here. So we always start to see where that money moved, down, down, down. 1 minute detachment, 1 minute entry, okay? So we're selling while the masses are buying because we're thinking like the market maker. So that's kind of inducement. Very similar to traps, really. We have traps at that order block mitigation, but we also have traps in this leg up here for targeting. So we're going to look at that now, or next. So build up leg. So this is the same chart as this one, but we're looking at the build up leg. The leg that, started the move to that order block. Because this in turn gives us targets, which we'll look at as well, okay? So our build-up leg is what price creates before mitigating our order block and sweeping its inducement. So price will either create continuational structure or create weak build-up structure to take out. And of course a vector level, which tells us exactly what's going to happen when we react to it or break it, okay? So looking at this build-up leg, everything in this leg is mitigated to this point, to this singular point here. So in this case, our vector level coincides with our last point of demand. Why? Because this low got mitigated by this, which mitigated this to this to this. This swept, right? So this is actually a trap. It swept into that range, mitigated. All these wicks here are mitigated, no imbalance. Okay, so that last point of demand was at this singular point here, meaning that once we break that last point, we're going to run to this low and further, okay? what the question is of when it runs to this low is it this low acting as inducement for a zone on the high time frame to the left down here? And that's where we can look at the different strengths of inducement and gets a little bit more advanced from there. But in this case, we have our final form of inducement at this point. After mitigating that last point of demand, no more demand can fulfill any buy orders up, and supply has taken total control to wipe out that leg. So what do we need to see in this build-up leg? We need to either see a fully mitigated leg, okay, because we can't use already mitigated zones, and smart money traps, which we go over in the premium lounge. And we know that this is a smart money trap based on our rules as well. A lot of people get trapped here thinking, they'll sell to this point here. But that's really what our build-up leg should consist of if we want to target its low. And this will also determine this being a weak low. As soon as everything's mitigated or has traps within it, which essentially traps are just already mitigated price action that look like they're still active, but they're not. Okay. And then that last one, last counterpart of the setup I look for is targets. This is where it can get a little bit tricky, and this is where even I tend to get stuck on sometimes, like being a bit greedy and not partialing when I should, okay? So targeting your trades is where a lot of people go wrong, but the objectivity in the market allows us to pay ourselves at certain intervals. So the main rule of thumb to either partial or take full profit of your trade is to trade until the next potential reversal inducement level of an active zone. So essentially this is saying that we're trading to inducement level of an order block that can reverse on us. We don't always know if it's going to reverse or continue from that order block, right? And that's why we have our inducement levels as undetermined. But looking at this, for example, I'm happy to target here 100% because I know this leg is a trap leg, for buyers now. But if we're holding this trade down and this low is acting as inducement for something on the high time frame, I'm only going to trade to this low. Why? Because we might reverse from here and I might get liquidated. So at this point, realistically, personally, I would partial 60 to 80% on this low. But like I said, we got to go on the high time frame. Look what's happening to the left. Is this low inducement for something else? And that's that predetermination in the market that we got to look out for. We can decipher inducement levels based on their interaction and what we enter after sweeping them. Like I said, once we sweep an inducement level for an order block, the order block strength, the internal breaks that caused that move that order block created, it's really dependent on whether we get a reversal or just a pullback and then a continuation. So we can actually break these inducement levels down to minor, medium, and major. After the lesson, bro, because you're in the premium group, I'll explain these to you because they're definitely worth mentioning. But because this is free, I can't actually explain each one. But
Sure.
minor and medium produce pullbacks rather than reversals, so we can hold our trade through these. Whereas major is for reversals, okay? There are specifics to these strengths that we go over in the premium lounge. We should partial at levels of uncertainty because we're not right 100% of the time. A lot of people, including myself, are a bit stubborn, so we might, not partial to trade thinking we'll make more money from hitting the final take profit. But if you have uncertainty about a zone, just partial there. You'd rather pay yourself, maybe put your stop loss at break even, because we're not always 100% right, okay? But yeah, let's have a look at kind of an example if we're in a buy trade. Sorry, one sec. So if we're an example of a buy trade here, and we got into this one, let's say, we had a nice reversal entry from this point, and we're in this trade, and we don't know what's going to happen to the right of entering here. So we have some uncertainty, of course. So what are we going to look for? We're going to look to the left to kind of confirm where we want to trade to and from. So just going up, right? Here we have, a sell zone because we had demand and then we moved down from that point. So we have orders injected into the market, but we're not creating inducement for that zone yet. So that's something we want to call out straight away. For me to do that, I actually get a box and I put a box just under this point to signal to me that we have not created inducement for this zone yet. So targeting that high is a good thing to do. Um, but like I said here, we can partial at the start of the zone. If we don't have time to see if inducement's going to be made for this area. And down here as well, we have some sell orders here. Why? Because we had the break, and then this slightly grabbed some of those orders, but it's quite weak, obviously, because we have imbalance above. And we created a little bit of inducement for it, but that inducement ended up being inducement pullback for us to react to that zone, sweep liquidity, and then we have a very nice setup here, okay? So partialing here is a great idea, especially if you don't want to look at the charts all day. But it's all dependent on what's happening to the left, okay? But yeah, great little entry here, continuational entry on New York Open at this point, okay? So the next point is partialing this high. So how can we actually partial this high? Well, we got to wait for that inducement. So not entering those top week refinements here, we create a bit of sideways price action where we have a respect of a high. Okay, so we can think of that as a retail trap, and then we sweep that. But most importantly, our vector level, right here, sweeping what was caused here is has a large imbalance, has a large impulsion, but we create inducement for that as a continuation. So if we're in this original trade, we have a lot more safety seeing that we're inducing for a continuation. And that's what I mean by continuational structure. We want to see open zones being induced for it to, reach our final target. Okay? So looking at this, we're actually able to just trade continuational trades from these manipulation points to our final target. But what this is also doing for us, it's allowing us to follow the money and understand that this high is not able to produce a reversal, just a pullback. Okay, so it does take some time looking at the chart. Um, but if you're unsure about something, just partial. It's a great way to do it. Um, and obviously, not a lot of inducements being created for these zones either. It's a small range of inducement. When we have that, yeah, we are inducing, but what those usually cause are just inducement pullbacks. Because, like I said originally, with the inducement formula, the more inducement taken, right, equals the distance of that order block mitigation movement. Small amount of inducement means this mitigation, this distance, is from here to here, because it only took a small amount of people. Same with here. Inducement, a little bit of inducement, right? Small amount, distance, here to here. That's what that inducement produced. The more inducement, the bigger the distance, yeah? This one, for example, right? It's here to here. That's what this inducement created. But you can see we had a lot more respect of a retail level than something like this. So we created that big move, okay? Does that make sense? Take those yes. Okay. So secondary elements. So obviously we have those four counterparts which we went over, which are order blocks, inducement, we have the build-up leg, and targets. Okay. But we have some secondary elements which we want to look at as well. Before we just jump into a trade. Now, that the first one's time and price, right? Price only manipulates at certain points of time. Okay. We don't manipulate, out of time. Instead, we create structure to end up getting manipulated or run out of time. So we want to be in session. And most often, this is London or New York Open, often plus 30 minutes of these, and our magic minute manipulation times. So our 90-minute cycles if you have a question about that, we'll go over that at the end when we're finished. The next one's momentum, which we just discussed a little bit before. But momentum is realistically formed from having a fractal higher time frame to lower time frame nature. The fact that the higher time frame is influencing the lower time frame provides, that momentum which is in the market, which is kind of cool. We've created momentum by using a fractal high time frame to lower time frame nature. So I think that's kind of cool, to be honest. Call me a nerd if you want. So this can help us decipher targets, inducement needed to take out, and a higher time frame influence on current PA. And of course shifts, so like reversals. So momentum's super important and no one really talks about it. Inducement strength, so we got minor, medium, and major. Those different inducement strengths will determine, whether we're going to have reversals or pullbacks, and some daily cycle factors as well, like how the Asia sets itself up, what we're doing in London, what we're doing in New York, and more. So I can't give away absolutely everything, but all the other infos, we've recorded on the Premium Lounge, and there is more to come. And at the end of the day, people do sell this kind of info for ridiculous pricing. But my intention is to have a good, tight trading group, help each other, discuss things, and just grow all together so we can all benefit. Um, okay, so just the last 4 slides we're going to look at is kind of what we want to see as setups in the market. They're always going to look different, okay? But there's 4 main setups really, because at the end of the day, the market is made of liquidity buildups, reversals, and continuations. That is a cycle that goes on and on and on again, okay? But that's it. If we break it down objectively into those 3 things, we can benefit hugely, okay? So this first one is a bullish setup. Won't talk too much about it, but we have original break. We have a 5 or 15-minute order block. Okay. Now this will be our phase 1 inducement. We'll create that vector level, or that shock inducement. We have that phase 2. We form a new order block on the 1 minute, and then we're able to trade from that order block if we have that phase 2. Phase 2 will look different every time. Phase 2 can be before the order block after sweeping phase 1, or it can be after, which is a lot more passive for us to be able to capitalize on. Okay. And obviously we have a build up heading into our POI, and we also got to evaluate the build up leg as mentioned before. Next bullish setup is a pullback continuation. That's really it. We have reversals and we have continuations, and then we hit another reversal, continue, reversal, continue. That really is it. But from this pullback zone, we have inducement level, we pull back from there, we end up inducing that vector level, okay, on the bottom side. The top side will act as a smaller build-up on a lower time frame, and we can actually play this as a phase 2 reversal. How so? Time frame. If this is on the 1 hour, this will be a 15-minute OB, which means we can play a 1-minute phase 2. The little exception here is that momentum is on our side. So things are going to be a lot more volatile, a lot more quicker to the bulls. So we don't want to be too greedy waiting for too much inducement, okay? Because look, we have a bullish momentum. But yeah, that's the power and what I call a golden setup of a higher time frame inducement pullback. We can play that 2-phase reversal on a lower time frame here, okay? But yeah, very nice setup, something like this. Targeting that high is also a great partial. Because as supply is now mitigated, you can end up even targeting that to that next inducement level. Bearish setup, so reversal 1. If we have a bearish reversal, we have an order block. We have our phase 1, same as our bullish, exact same, just flipped really. Vector level gets broken, and we create that phase 2. Can be before or after the order block, of course. And then the final one, we have inducement pullback for a bearish setup. We're reacting to pullback demand, right? Sweeping inducement. We always have to have some form of inducement for our zones. And from that point, we sweep. We're actually manipulating into our vector level. This will act as a build up, and then we're able to trade from that point. And just like I said, if this is a 1 hour inducement pullback, we can play this like a two-phase reversal. This will be a 15-minute phase one, right? And then we'll create a new 1 minute phase two zone, which is awesome. And such a high probability way to look at the market as well. But yeah, that's it for today. I hope you enjoyed it a bit. A little bit more advanced than the other free one we had, but I wanted to benefit everyone, even in the premium group like you guys. So I appreciate you tuning in. I'll just stop the recording. Just give me 1 sec.